This is Perspectives, a bi-weekly investment podcast brought to you by Escala Partners. In a world cluttered with information, Perspectives cuts through the noise to bring you insights and commentary on global financial markets, economics, and geopolitical news and events.
Hello everyone, and welcome to the Escala Perspectives podcast. Today I'm joined by Gerard Minack, our independent investment committee member, for a live discussion marking the launch of our Agenda 2025 publication. We hope you enjoy the conversation.
So you have been busy. You're just back from a client trip to Europe. So I thought it might be a good idea to start with that. What are the clients in Europe? How are they feeling about Trump, about their own economies? What's the vibe over there?
The vibe amongst the international investors I talk to is still very bullish on the US. And I have to say, sentiment is often a great trailing average of the last couple of years' performance, and the US has done very well, so everybody remained quite upbeat. We might get onto this, but I was telling them to perhaps think that the US might be peaking, and that was a story that fell on incredibly barren ground. On Mr. Trump, look, there's a range of opinions, but we all know that he's absolutely lifting uncertainty, and as Pep said, I mean, the thing to expect is the unexpected, and that pattern's continued in the 3 weeks since I've been back. There's still a fixation on the big US tech companies, and these are enormous. I keep on telling my Australian clients that the average size of each one of those Mag 7 companies is individually larger than the entire ASX 200. So it's a little bit humbling when you see it in that perspective. They are almost a standalone asset class in themselves. They're very down and dismissive on their own backyard. As I say to people, in an investment sense, everybody hates Europe, including the Europeans. And the other place that has really fallen off investors' sort of like list is China.
Yeah.
Now, there is an irony here. If you look at performance year to date, guess what? The Mag 7 is down, the US is underperforming, and the best two major regions are Europe and China. So I came away from a sense of where they have been positioned, and ever since then, everything's gone awry for them. Now, it's only 6 weeks into the year, or 8 weeks into the year, so we're not saying that is a confirmation that the trend has changed, but it does underline the point that once everybody is so bullish on one particular thing, that can often represent something close to the top in that market or that thematic.
It is something that we're conscious of in terms of valuations, but one of the things that we're always saying is that valuation is a poor timing tool, that you often need a catalyst that would cause the valuation to correct. I note on Sunday we had the German election. What were the clients talking about in regard to the politics in Germany, and actually even in France as well? France is going to the polls, I think around June, July. What are they saying about their politics?
Well, I mean, the first thing is, right through our careers, last 30 or 40 years, whenever we've been talking about policy risks, we almost exclusively are talking about central bank uncertainty. What is the Federal Reserve going to do? What is the RBA going to do? And when we talk about interest rates, they're very monodimensional. I mean, they're either going up or down or sideways, that's it. All of a sudden, we're all learning to adapt to a world where politics is a very intrusive or potentially intrusive factor to our investment decisions. And what makes it more complicated is this generalised swing against incumbents. I mean, last year, and this is data from the Financial Times, last year was the first time in the post-war period that in every developed economy election there was a swing against the incumbent. 100% swings against the incumbent. And we're also seeing a big move away from major parties. So the German election, where, guess what, there was a swing against the incumbent. So the Social Democrat Party, which lost, they recorded their lowest ever vote in their history. The Christian Democrats, who won, received the second lowest vote ever in their history. And it's a little like what we've seen in the UK, where Labor won with a very low vote. It's what we're seeing here with the collective vote of the coalition and Labor going down, adding a whole degree of uncertainty. Not all of it's bad. Asked about Germany specifically, I mean, there is the general hope that what they will do is relax their fiscal policy. In Germany, there's a constitutional amendment that means that they can't run budget deficits much more than 0.3% of GDP. They call it the debt brake. The new Chancellor is going to try to get rid of that debt brake, partly to fund an increase in defence spending, which for obvious reasons we know why. That would be good. I mean, Europe needs some stimulus. Germany has been the sick man of the European economy now for a few years, and it's really been stagnant. So I actually see this as an upside risk for Europe, which would run counter to that extreme pessimism that a lot of the investors have about the region.
Yeah, it's going to be difficult, isn't it, though, to form a government with some sort of coalition, because in third place was the Alternative for Germany party. I think they got their highest ever vote, but have ruled out working with the AfD. Germany has, and in fact, interesting. I mean, there is this swing to the right, but even Marine Le Pen in France and Meloni in Italy have both also ruled out working with the AfD. They are just way too right. So trying to sort of form this government and then trying to inject some stimulus in. I think Merz, the new Chancellor, has talked about increasing defence spending.
Yes.
Which is a theme, isn't it, throughout Europe, and it's in the UK as well. The UK talked about increasing their defence spending. Is NATO dead, do you think? What's happening with NATO?
It's on life support.
Yeah.
So let's see whether there'll be the last rites. But look, this has been a thematic that's been obvious for a little bit of time, certainly since the Ukraine invasion, but even predating that with China and the US facing up more aggressively. So we've seen a big increase in defence spending in most developed economies. I think a majority of NATO countries are now hitting their 2% of GDP target, but Mr. Trump's telling them to go to 4 or 5%, which is probably a stretch, but we know it's going to be increasing as a share of GDP. And the recent aggressive speech by J.D. Vance saying the biggest enemy facing Europe is not China or Russia, but it's your own internal problems, really probably is going to spur them to do more spending. And what they may do is decide to issue Euro-wide bonds to fund it. So debt mutualisation, which would actually start to bring Europe closer together.
One of the concerning things that we've noticed, though, about Europe is that this time around, 2011, Europe was also going through some dire straits. Greece were threatening to leave the euro and Spain was in trouble. It was the periphery. This time around, the periphery is looking surprisingly good. Greek banks are being talked about in our fund manager meetings as a good buy. Spanish banks. But now it's the core that is sick. Is there a chance that the European Union experiment can come undone, or is it similar to unscrambling eggs? Is it?
Never say never. There's a chance. Go back to that euro crisis in 2012, and at the time I was working at a big US bank called Morgan Stanley, and we used to talk about Europe in the context of we called CRIC cycles, CRIC, and these were cycles that started with a crisis, then you got a response, then you got improvement, then you had complacency until you went back to your next crisis. And the point of the framework was to get Europe to move. I mean, this is possibly true in a lot of places, by the way, but particularly in Europe, you need a crisis. But the good news about a crisis is it does finally prompt them to do something that's important and beneficial. And I think we could be going through a CRIC cycle now. This crisis about whether NATO will continue to operate, what Putin's intentions are, I think could be the catalyst for Europe to come closer together, become self-sufficient. They have been free riding on America's defence coattails, and ultimately get improvement. And if that also is combined with some of the reforms that Mr. Draghi has been promoting, so deregulation, that would be absolutely terrific. And in the context of how that matters to us as investors, and you've probably all heard about this idea of American exceptionalism, and that's driven America's equity outperformance for the last 12 years. No one I know is in their wildest dreams thinking that Europe will, in an absolute sense, overtake America as a better investment destination, as a faster growing economy, and neither will Japan, neither will Australia. No one's thinking that. But the point about American exceptionalism now is you've got such a premium valuation on American assets. On my numbers, they're trading at a record level of valuation premium to the rest of the world. So the question is not whether the rest of the world will overtake, the question is whether the gap will start to narrow. Mm-hmm. And all you need to see is the gap narrow, and with everybody one way, very pro-America in an investment sense, then you can get the drift back. So it's all about changes at the margin. So if we do get not Europe becoming as deregulated as America is, but Europe moving towards America, if we do see more defence spending, if we do see slightly faster GDP growth, these are all things that the premium valuation on America starts to look a bit shaky. Now, timing that is very difficult. I think it's going to start this year, but this year, I'm giving myself a whole year's wriggle room. We all know with valuation, it works fairly well over the long run, and by long run I mean 5 to 10 years. As a 1 year ahead predictor, nah, forget about it. As you said, you need a catalyst. But we could be looking at some catalysts. If we do get some sort of resolution to the Ukraine conflict that does lower energy prices in Europe, but the threat of NATO breaking up does spur Germany to relax its debt brake. If Europe does up its economy-wide defence spending. Now, there's a lot of ifs and buts there, but I think there's a chance some of them will happen. Equity markets outside the US do better when the dollar comes down. So now, this is a big subject. I'll just give you the very short answer. I think a number of the things that have propped up the dollar over the last US dollar, over the last couple of years are going to start to weaken. I think the growth differential is going to start to weaken. I think the interest rate differential is going to start to weaken. So we could see the US dollar come off a little, and that would be good for those non-US equity markets. Now, this is a comment absolutely subject to Trump risk. I should have said that at the front. Everything I'm saying today is subject to Trump risk. One thing about a currency is if you impose a lot of tariffs, that tends to push your currency up. So if Mr. Trump does go bananas on tariffs, the US dollar will not weaken, it will stay solid. So that is absolutely a risk.
That is, at a high level, what is the impact if these tariffs do come into effect in some format? What is the initial impact, and then what is the sort of more longer-lasting, medium-term impact?
Yeah, look, the initial impact is to increase the price. It's like a tax on US consumers. So there's a small, probably one-off inflation effect. The uncertainty is whether the rest of the world retaliates. It probably would, which starts to put sand in the gears of the global trading system, which is not good for growth or productivity. I would think that the bigger impact is actually the chilling effect that the uncertainty of tariffs and whether they will persist can have on CapEx. When you have bipartisan agreement, for example, that we need to protect some strategically important industries from China, so it's bipartisan, then everybody goes, okay, now we understand the rules and we'll change our investment behaviour to reflect that. But if we've got a whole lot of so-called Trump tariffs that people will think, you know what, if the Democrats get back in 4 years' time, these tariffs are going, then I'm not going to build a factory in the US that's only going to be viable for a 4-year time horizon until the tariffs get removed. So the initial impact is on prices, potentially also the currency, but unless people believe that these are permanent tariffs, and I don't see why they should think that for most of them, I think it just chills out investment in a very detrimental way. I mean, look, if having high tariff trade barriers were the secret of economic success, North Korea would be the richest country in the world.
But Biden didn't take off Trump's first round of tariffs.
On China. So the point there was it became bipartisan specifically regarding China.
On China.
That's it.
Yeah.
And so that's why I think if you do have an overlay of we're doing this for national security reasons, it's got a better chance of sticking.
Yep.
If you're doing it just because it's a negotiating ploy or, I don't know, the Trump White House seems to have a particular bee in their bonnet about Europe, so we're just going to beat up on Europe, I don't think anybody would assume that that's going to persist for a really long time.
Okay.
I would assume.
So the initial impact is a one-off jump up in prices, but a medium-term impact is on CapEx. And what about corporate profits? A lot of the companies based in the US do actually import the inputs into their production process. Aluminium being one of them. I think that one is due to take effect on March 12, 25% tariff on steel and aluminium. The impact that this could have on corporate profitability? This
is why you can't just look at tariffs in isolation and say, well, there's obviously a winner, the steel and aluminium industries. If they get protected, it's great for them, which it is. But for anybody that uses US steel or or aluminium in their processes, their costs are going up. So American car makers, for example, would become less competitive in third markets because their input costs are no longer the lowest in the world, they're being protected. So there's winners and losers everywhere, and the upshot of this is it's not at all clear that imposing these tariffs will ultimately shrink America's trade deficit, because yes, you'll be importing less steel and aluminium, but you may end up exporting fewer cars because you've made them less competitive. And this is why I'm a card-carrying trained economist. Most of us don't like protection, don't like tariffs. It's not just that we they don't work, is the bottom line.
Yeah. Most of the fund managers that we've been speaking to through our last Heat Week have been basically saying that companies are viewing this as a 4-year term, less than 4 years now, almost that there's not going to be a second term unless he changes the constitution. And you could even shorten it even further by saying it's a 2-year term because you've got the midterm elections. Usually that doesn't favour the incumbent. What are your thoughts on that? And can he change the constitution?
Well, let me put this in a slightly broader context. I mean, ever since Mr. Trump's been elected, and like you, I've been discussing him with my investors, I found it's a bit like giving them a Rorschach test. I mean, you show them the Trump ink blot, and what they say they see says at least as much about them as it does about Mr. Trump. My more bullish clients say, well, the good thing about Trump is he's going to deregulate, he's going to cut taxes, he's going to cut government spending. My more bearish clients go, he's going to kick out a lot of migrants, he's going to introduce tariffs, and it's going to be general chaos. All I can say as feedback is that there were more Trump bulls than there were Trump bears. And the market came into this, I think, pricing in a glass half full Trump. The problem, I said to them, without having any edge on what he could do, or what he would do, is it was far easier for him to do the bad stuff up front, because to address the migration issue, to do the tariffs, are all largely done by executive orders. There is no congressional constraint. To get tax cuts, spending cuts through, you need legislation, which simply takes time. So the risk was, and I think we're starting to see it unfold, is investors were looking for, as I said, a glass half full Trump, and the sequencing is simply that we got the nasty stuff up front. So to your question, yes, he may lose control of the Congress in 2 years' time, but he'll still have that executive order power, and he'll be able to continue with the stuff that people don't like that much. In fact, he might have to resort to that more. The other final point I'd make about controlling Congress, put it in air quotes. I mean, the House of Representatives, they have a very small majority. The congressional Republicans are a very fractious lot. It's a majority that may not always be able to stick. And in the Senate, of course, aside from 1 or 2 bills a year which are related to fiscal policy, you need 60 votes to get something through, to break the filibuster, which obviously they don't have. So it's not control of Congress like an Aussie government has control of Parliament. There's a lot more checks and balances in legislative areas. So I think you'll get through potentially one big tax bill. For those that follow these things closely, House of Representatives passed a resolution last night. Despite their fixation on deficit, it's going to increase the deficit by about $3 trillion over the next 10 years. So we've got a huge deficit about to get bigger. That may in 2 years' time stand as his only major legislative achievement. And then he'll just have to stick to executive orders, which he can still pummel away on the tariff front.
The point that you made there about the Republicans not standing behind each other is, again, consistent with what our American fund managers have been telling us. The Democrats will all line up behind the leader, whereas the Republicans are more splintered, and it was the Republican vote that impeached Nixon after all.
And in his first term, he couldn't repeal Obamacare, which was a big promise. This term, one of his big promises is to repeal the Inflation Reduction Act, which was the Biden program on green matters. But the irony there is that 80% of the spending on that program goes to Republican districts. So all you would need is 2 Republicans to say, I'm not going to kill this program. It's generating a whole lot of jobs in my electorate. So as I said, there's a potential gap between what he wants to achieve and what Congress will actually let him achieve.
You spoke about the budget there, and it's likely to increase, and I mean, everybody sort of knew that anyway, didn't they? Because the demographics were ageing, healthcare is getting more expensive, need more defence spending, infrastructure, if the US is going to reindustrialise, needs to do something with its ports, roads, rail, etc. So, okay, the deficit is exploding. We're now at $1 trillion in interest payments a year, actually more than what they're spending on defence. At what point does the chickens come home to roost on the debt? Interest rates, the bond yields are still coming down, and the US dollar's going up like nothing is wrong.
Yeah, there is a limit to how far they can push it, but we're not there yet. I think that the markets willingness to tolerate these enormous US deficits would be unsettled if they started to worry about Fed independence. So in other words, if there was a perception that Mr. Trump was going to try and directly influence interest rates in a way that would benefit him, that's when the so-called bond vigilantes really sit up and say, hold on,
Right.
You can't fiddle with interest rates and run massive deficits. That's a mix that we will not tolerate. Now, he hasn't done that yet. He has been firing people that have been statutory appointments that are only meant to be fired for good cause, and he's just gone along and said, you're out. One of those people is challenging his right to be fired at the Supreme Court. I'm not a lawyer, but some of the legal experts I'm reading suspect that the Supreme Court will say, yes, it is okay for Mr. Trump to fire someone without any reason, even though there's an act that says he can only fire for good cause.
Another strange occurrence in the market at the moment is gold. Normally, gold trades in the opposite direction to the US dollar. So the US dollar goes up, gold price tends to go down. It's not.
No.
So what's going on there?
Yeah, gold's interesting. I always think of gold as this sort of chameleon. Sometimes it behaves like a currency, sometimes it's like a commodity, and sometimes it's a safe haven. And one of the things that gives it this attribute of being a safe haven is it's a financial asset that's not someone else's financial liability. So there's no counterparty risk. What we normally see gold behaving is like a currency. So as you said, when the US dollar goes up, gold goes down. If US interest rates go up, gold goes down because it's a currency that has no interest rate. That all changed first half of 2022. And what changed it was Mr. Putin marched into Ukraine, and then the West grabbed all America's US dollar FX reserves. So all of a sudden, a whole lot of people said, you know what? We don't want to keep our safe haven as US dollar assets because we've just worked out that America, well, in this case it was Europe, but they could be grabbed. So let's move some of our money into gold. So all of a sudden, gold stopped being predominantly a currency and started to become a safe haven asset. And in that context, it's worth remembering that gold is actually quite a small asset class. In terms of investable gold, it's $3 or $4 trillion, whereas global sovereign bonds $100 trillion, and the global equity market is even larger. So if you just get a relatively small movement out of, for example, treasuries into gold, the treasury market almost doesn't notice the selling. The gold market explodes as you get this massive buying. So I think that's what's happened. The problem for us as analysts and trying to do some forecasts is, if you say, okay, so if we've got this safe haven bid for gold, what's the fair value? I go, I don't know. I don't have a model to tell me that. All I can say is if there's more flows yet to go, it's probably going to go up.
Is this the start of the US no longer becoming, and the US dollar no longer becoming the world's global currency?
I think we're a long way off from that.
Right.
I mean, there's still huge networking advantages. Yep. Why do, if I was an exporter, well, actually I am, because I sell my subscriptions overseas. I charge people in US dollars because they're all so used to paying for things in US dollars. And I think last time I saw, it's still true that close to 80% of all foreign trade transactions occur in dollars. The vast majority of cross-border lending is in dollars. So that grip on the system remains, I think, fairly strong for now. There's no obvious competitor. I mean, you can't use Chinese renminbi because they don't have an open capital account. Europe, potentially, but the US remains number one for now, I think, is the world's reserve currency.
Okay. What's been very quiet, or who has been very quiet in all of this, is Xi in China. I mean, he almost doesn't need to do anything. He's sitting back just watching Trump make a mess of things. What are your thoughts on China?
I think that's partly true. Was it Napoleon that said, never interrupt your enemy when they're making a mistake? I think the other reality is he's focused on his own set of domestic problems. I mean, China is not in a good shape at the moment. They've got a big structural problem in that their household sector saves massive amounts of money, and that means that they've got to do a lot of investing. Now, spending 40 to 45% of your GDP on capex is historically so abnormal, both relative to China's own history, but also other developing economies. I mean, you're looking at a country like Australia where we invest 15% of our GDP on capex. So they're doing 3x what we're doing. That strategy worked wonderfully well when you were using that investment to build factories to make stuff for Westerners and you exported it all away. Well, that strategy fell to bits after the GFC because we saw slower growth in the West. So then they started to investing the world's largest fast train network, first-rate airports in third-rate cities. They spent it overseas for the Belt and Road Initiative, but most famously, they put a whole lot of investing into their housing market. And the consequence in all those areas is they've gradually led to excess capacity. They're not fully utilising most of that domestic infrastructure. The Belt and Roads Initiative is starting to lose momentum, and of course they've got a gigantic excess supply of housing. So that's starting to bite now, and you're seeing the financial stress that comes through that massive misallocation of capital. If you look at their equity market, it's done very badly, and part of the reason there's so much excess capacity, no one's got much pricing power. So yes, Chinese EVs are taking over the world, but they've commodified it and they're not making much money. So here's a fact for you. Over the last dozen years, Chinese GDP's up, I think, 250 to 300%. EPS is basically flat. So they've got no ability to translate GDP growth into earnings. So this is all these sort of excess capacities now coming back to haunt them. They've got a corporate sector that's got a massive amount of debt. They've got no pricing power. Economy-wide prices are actually falling, so not rising, so the deflation. So this is a real focus now for the Chinese leadership, and you are starting to see some changes at the margin, and even some of it's just almost trying to bring the private sector back in from the cold. He had a big meeting with some of the senior tech executives who he'd put on ice a few years ago, so he seems to be warming up there. So this is a potential source of upside risk, but as I said, I think it's one reason Mr. Xi is quiet. He's much more focused on trying to get the domestic economy in a healthier way because it's in a bad way at the moment.
That kind of leads us into Australia. One of the reasons why the investment team and I are not very optimistic on Australia at all. What are your thoughts there? Did Michelle Bullock at the Reserve Bank, did she need to cut interest rates? It didn't sound very convincing to me when she was in a press conference.
Yes. Look, I've got good news and bad news. The good news is that from where we were last year, things will get a little bit better. If you look at real household disposable income or real household disposable income on a per person basis, the decline we saw last year was the largest we've seen in the post-war period. I mean, it was deeper than what we saw in the 1990s recession. So it was a debacle, and households got hit by three things. They got hit by higher taxes, they got hit by higher rates, and they got hit by higher inflation. The only reason, well, there are two reasons why that didn't push us into a proper recession. The first reason was that we did have a piggy bank of saving from the handouts that we got in the pandemic. We drew down on that. And the second thing is government spending was quite strong. So over the year to September, GDP in Australia was up 1%, of which government spending contributed 1.1%. So the private sector got snuffed out last year. So from that starting point, things will get better because we've now had tax cuts, we've now had rate cut, and inflation has fallen, so real incomes are starting to grow again. So that's the good news. The not so good news, if you abstract from these swings, which are really, a lot of it's pandemic related, and look at the underlying trend, Australia's real growth rate on a per person basis since roughly 2012, so it's now a dozen years, is very, very weak, very mediocre, much weaker than what it had been in the 15 years before that. So cyclically we're looking better, structurally we don't look terrific. And the root cause of that slower growth is that we are doing so little investing. And that investment spending that we are doing is being stretched over a very fast growing population. So if you look at how much capital each person or each worker has, it's no growth over the last 12 years. And guess what? Because we haven't given any of our workers any more capital, their productivity is basically flat over the last decade. And if you're not more productive, you can't pay yourself anymore. So the root cause of this lacklustre decade is the combination of weak investment and fast population. And just to quantify how bad investment has been, if you look at investing in Australia ex the miners, because they've had big booms and busts, so this includes private corporates, but also government infrastructure, so private and public ex-mining, after depreciation, so new capex. At the worst point of the 1990s recession, so the 1990s recession was the worst recession in Australia in the post-war period. At the low point, investment got down to about 5.5% of GDP. Over the last 10 years, non-mining investment has averaged about 5.5% of GDP. In other words, we've had a decade of investment that you've only ever seen at the lowest point of our worst post-war recession. That's how bad our investment story's been. So that's a diagnosis. The bad thing is I can't see any clear-cut reasons that it's going to change. There will be a cyclical pickup, but I'm not seeing any reason why we should see a dramatic pickup in investing. And if that's the case, then we're going to stay to a fairly, unfortunately, lacklustre growth trend.
And going into, well, we're not in election cycle yet, but we are. And so the policy stimulus just keeps on coming with now the Medicare and the coalition matching it. Like everywhere else, the government's deficit is going to continue to go up. Your thoughts there?
Yes, I mean, we probably do need some help for Medicare, but ultimately we need to prioritise fixing up this fundamental problem, because if we don't get real productivity growing, we're just going to be fighting over a cake that's not growing. And so it's almost a zero-sum story. I mean, the way to be able to afford more Medicare payments and more this and that is to have an economy that's growing. And I think in hindsight, I mean, some of you know my politics, but you don't need to know my politics. I think it was probably bad that Bill Shorten lost in 2019, just like I thought it was bad that John Hewson lost in 1993. They were both elections where you had promises to do action, whether you agree with it or not, at least they were up front, and they both lost the unlosable election. And the result was everybody said, let's do a small target, let's not promise anything. And so you had a government that said, we've got no promises, and they've delivered on that lack of promises. So we've had another 3 years of drift. And the sad thing about this election is if all we're debating is how big to beef up Medicare or how big to do, we need some changes. We need some tax reform. We need incentives to invest. I would argue we need to rejig our migration program, and yet that's not appearing anywhere. So you said I was bullish before. As I said, wait till you get to on Australia.
I knew if I kept on digging, I'd find the pessimism.
And I mean, the sad thing is, and let's then transfer that to rates. In the US, I've already explained, I do think rates are going to average a higher level now going forward than they did in the decade after the GFC. It's not clear to me that story is true here, because in the 5 or 6 years before the pandemic hit, we had real interest rates in Australia at around zero, and we weren't doing that well. That was not a stimulatory interest rate. So, I was saying to people, the neutral rate of interest, the rate of interest that doesn't stimulate or dampen things in Australia, is roughly zero after inflation. I think that's probably still true. And if that's true, I think ultimately, unless we get big fiscal stimulus, which is a risk, if that's true, ultimately the RBA can cut the cash rate back to 3% or lower. And that would just be consistent with an inflation-adjusted interest rate that's zero or just slightly above. So I think that's where we can get back to, but that's not a good thing. I mean, the reason we can go back there is that the economy is so mediocre and lacklustre, and we can't cope with higher rates. So, it's a double-edged sword. Great if you've got a big mortgage, but, it's not a sign of vibrancy or health. And on equities, I mean, this is not a terrific environment for our equity market. I mean, we've got, at first blush, our market doesn't look that expensive, but if you lift the hood, it actually is, for a couple of reasons. Of the markets I look at, I just look at what people are expecting earnings growth to be over the next year. In the US, it's 15% growth, and their market's on a PE of 23, 24. India is sort of similar. You've got slower growing markets that are on less. We're on about 18, 19 times, and the expected earnings growth for Australia is not 20, it's not 15, it's not even 5, it's 2%. 2%. And that's not an aberration. The last few years, that's all we've generated. I mean, so it's low earnings. But it gets even worse, because if you just compare the Australian equity market to, say, the US or to virtually any other market. We've got a much larger exposure to sectors like banks that normally trade cheap, and we've got a quite small exposure to sectors that everywhere, like tech, trade expensive. So when I sort of do an apples with apples comparison, for example, with the US, at face value we're trading at about a 20% discount, but when I calculate our market to have the same sector shares as America, we're on a 25% premium. So I'll give you one example of this. Infotech, the tech sector. So the tech sector in America is expensive.
Yep.
The tech sector here is twice as expensive as their tech sector.
Right.
We've got the world's most expensive banks. I mean, so although the sticker price on the tin looks cheap, you lift it up and you go, no, that's all pretty expensive.
Yeah.
Unfortunately, that's all we have time for. Thank you all for listening. We really appreciate the support. We'll see you all next time. Thank you.
Thank you for listening to Escala Partners Perspectives podcast. Be sure to subscribe to this podcast on iTunes. You can connect with Tracey by visiting escalapartners.com.au. Escala Partners is a corporate authorised representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast, and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.